Rich, speaking of wide ranges, they certainly are that for the strategists who are trying to predict what this next year is going to hold. You've got the Tom Lees of the world, whose target, I believe, is around 47.50. I don't know what, Jim Lebenthal has set for the new year, if anything, at this point. But you got lows of like 3,300 on the street. Wall Street doesn't have any idea what's going to happen in the new year. It just speaks to the level and degree of uncertainty that Shannon just articulated exists.
Yeah, well, the market continues to price in a pain-free disinflation. And if we look at the last 9 months, we've had declining leading economic indicators. We've had 12 months of declining home builder index prints. M2 growth is screeching to a halt. And we're on track for analysts ultimately to take an axe to 23 earnings. So all this uncertainty will basically lead to lower stocks in 23. Now, in the Q1, we'll likely get some positive prints in terms of inflation coming down, Fed moderating their increases in the tightening campaign. So that could lead to some short-term market exuberance. But in the end, the market has to face the fact that earnings are going to be marked down, and that's going to lead to lower stock prices in 23.
Are you as negative as you've been? And I think the last time we spoke, and maybe the time before that, you made the point, and for those who haven't followed you as closely as I have, obviously, you at one point had more cash than you've ever had, I believe, as a money manager, as an investment advisor. Is that still the case?
Yeah, so if you look at an average client allocation where, let's say they have 50% in stocks, let's say earlier in the year we moved into 40% in stocks, and we replaced that cash with bonds. Right now there's great opportunity in the bond market because if you ascribe to the fact that the Fed is slowing the economy, that's going to lead to lower interest rates on the long end of the curve. So long-term bonds here are attractive if you want to look out past what's going to happen given this Fed action.
But I see you buying some stocks, though. Now, albeit areas that have either done actually both areas have done well. You bought Northrop Grumman new last week, so defense stocks have done quite well, certainly relative to the market. And obviously, oil prices and energy stocks are the best performing group by a million miles. And you bought more Exxon. Can you take me through those two?
Yeah, so keep in mind that energy's had a great run, but energy is generating 11% of the profits of the S&P, but it only commands 5% of the market cap. So anywhere you look in the energy sector, you're looking at anywhere of operating cash flows of 10 to 25%, and free cash flows anywhere from, let's call it 8 to 16, 18%. So if I'm looking for a sector where I'm going to have copious amounts of free cash flow and I'm going to be insulated from market volatility, I'm going to choose the oil patch. Now, the argument against that is that if we get into a slowing economy, demand for oil will go down, and that will impact these companies. True, but I still really like the free cash flow of that sector.